If you want to learn about the stock market, you should start by understanding stock exchanges. The stock market is made up of multiple venues, including stock exchanges, such as the NASDAQ and the New York Stock Exchange, two of the most well-known exchanges in the United States. These are places where shares of public companies are bought and sold, driving the flow of capital in the economy. But if you were born before the year 1600, you wouldn't have had to learn any of these definitions. That's because the first ever stock exchange wasn't open for trading until 1611. The Dutch East India Company, which needed funding for its ocean voyages, decided to sell shares in the company and pay dividends, which is a portion of its profits to investors. Citizens of the Dutch Republic could buy these shares, which were then traded in open-air markets. One of those markets became the Amsterdam Stock Exchange. For many years, the Dutch East India Company was the only company trading on this exchange. Fast forward almost 2 centuries to 1792, when 24 stockbrokers and merchants gathered under a buttonwood tree on New York City's Wall Street. They made the Buttonwood Tree Agreement, creating what we now know as the New York Stock Exchange. So, how does the stock market work? Let's say you own a pet food company that you want to take public, allowing others to invest in it by buying shares of your company's stock. The funds from these investments could help you create new products, hire more employees, or grow your business in another way. To go public, your company would first need to talk to top investors to generate excitement about buying shares early. If they believe in your company's potential, they can sponsor its initial public offering, or IPO. An IPO is a company's debut on the stock market, where any company or individual can then purchase shares. After the IPO, the price of shares will fluctuate based on how much investors think your company is worth. As the company grows and succeeds, the value of the shares may increase, but they could also decrease if the company underperforms. The stock market is unpredictable, and even the world's most educated investors can't predict its movements with 100% accuracy. However, they can measure the market's performance using indexes. One of the most famous indexes is the Standard & Poor's 500, or S&P 500, which tracks how 500 large companies listed on US stock exchanges perform over time. Since 1957, the S&P 500's average annual rate of return has been approximately 10.5% or 6.6% after adjusting for inflation. Understanding the stock market is key to making informed investment decisions. Whether you're just starting out or looking to deepen your knowledge, remember that the stock market is more than just numbers. It's a dynamic system that reflects the growth and challenges of companies around the world.